remain elevated at 20% nationally due to persistent hybrid work patterns. Federal housing policy initiatives are targeting affordability through supply expansion and regulatory reform. Technology adoption continues to accelerate with 72% of 20%. Housing affordability improved with median monthly payments declining 8.4%, while pending home sales gained 7.7%, signaling renewed buyer activity. Spring housing demand rebounds significantly. After a prolonged post-pandemic slowdown, the U.S. spring housing market is regaining momentum with increased buyer activity and a return to more typical seasonal patterns. The National Association of Realtors, Real Estate Market News Report. Comprehensive Market Analysis, May 7, 2026. Executive Summary, Market Recovery in Progress. The U.S. real estate market is showing clear signs of recovery across multiple sectors as of May 7, 2026. The spring housing market has regained momentum with pending home sales reaching their highest level since late 2022, jumping 7.7% year-over-year. Mortgage rates have stabilized near 6.44% after earlier volatility, providing buyers with more predictability. Housing affordability has improved modestly for the first time since 2020, with median monthly payments down 8.4% year-over-year as rates eased and incomes rose. Commercial and multifamily lending surged 52% year-over-year in Q1 2026, driven by a wave of maturing loans requiring refinancing. However, challenges persist in the office sector where vacancy rates remain elevated at 20% nationally due to persistent hybrid work patterns. Federal housing policy initiatives are targeting affordability through supply expansion and regulatory reform. Technology adoption continues to accelerate with 72% of large commercial portfolios now using smart building systems. REITs delivered better than expected Q1 earnings with 16 out of 23 major REITs beating revenue estimates, prompting many to raise full-year guidance. The rental market shows diverging trends with coastal cities like San Francisco seeing rents surge 19.9% while oversupplied Sun Belt markets experience declines of 4 to 7%. The chart illustrates the diverse performance across market segments, with commercial lending experiencing the strongest growth at 52%, followed by office vacancy and San Francisco rents both at elevated levels around 20%. Housing affordability improved with median monthly payments declining 8.4%, while pending home sales gained 7.7%, signaling renewed buyer activity. Spring housing demand rebounds significantly. After a prolonged post-pandemic slowdown, The U.S. spring housing market is regaining momentum with increased buyer activity and a return to more typical seasonal patterns. The National Association of Realtors, NAR, projects existing home sales will climb roughly 10.7% above April's levels, aligning with pre-pandemic spring market trends. During the 4 weeks ending May 3, pending home sales nationwide reached their highest level since late 2022, with seasonally adjusted contract signings jumping 7.7% year-over-year. This surge was fueled by a brief dip in mortgage rates and improving affordability, with the median monthly housing payment falling 2.2% year-over-year as 30-year mortgage rates pulled back to 6.23% in April. Housing supply also rose about 1% year-over-year to its highest point in at least 5 years, giving buyers more options. Google searches for homes for sale hit a 9-month high by May 4, up over 20% from last spring, reflecting a burst of public interest. However, conditions remain more measured than in the peak pandemic market, with the typical home spending 43 days on the market, 3 days longer than a year ago, and only 26.4% of homes selling above list price, the lowest share for this season in at least 5 years. Housing market activity indicators. Indicator. Current status. Pending sales, YoY change. Plus 7.7%. Median monthly payment, YoY change. Minus 2.2%. Housing inventory, YoY change. Plus 1%. Homes selling above list price. 26.4%. Typical days on market. 43 days. Regional housing market performance varies widely. Housing trends vary widely by region this spring, reflecting local economic conditions and previous market swings. Several Midwestern and Northeastern metros are seeing significant jumps in sales. Chicago's pending home sales soared 19.2% year-over-year, Pittsburgh's rose 16.5%, and San Francisco witnessed a 15.2% annual rise in contract signings as that market stabilizes. By contrast, some previously booming Sun Belt markets are lagging behind. Houston's pending sales fell 9.3% from a year ago, illustrating how local factors like economic diversification and affordability constraints can dampen a spring rebound. Metro area. Pending sales YoY change. Market condition. Chicago. Plus 19.2%. Strong recovery. Pittsburgh. Plus 16.5%. Strong recovery. San Francisco. Plus 15.2%. Stabilizing market. Houston. 9.3%. Slowing growth. Many Rust Belt and Midwest markets that didn't overheat during the pandemic are benefiting from solid affordability and job growth, while parts of Florida or the Mountain West that saw huge price spikes and in-migration flow now face relatively slower recoveries. Pricing stabilization is evident nationally, with the median sale price around $395,000, up only 1.9% year-over-year, a far cry from the double-digit annual gains seen during the pandemic. Mortgage rates stabilize near mid-6% range. U.S. mortgage rates are holding near the mid-6% range as financial markets remain calm and Federal Reserve policy stays steady. The average 30-year fixed mortgage rate sits around 6.44%, reflecting a modest improvement as the 10-year Treasury yield edged down to roughly 4.33%. Bond yields and energy prices have eased. The 10-year yield slipped a couple basis points and oil fell to about $91/barrel, slightly relieving upward pressure on mortgage costs. At 6.44%, the 30-year rate remains more than double its early 2021 record low of 2.65%, underscoring a new normal of higher financing costs. The Federal Reserve's stance is a key factor keeping rates range-bound, as markets broadly anticipate no immediate Fed rate cuts even as the central bank approaches a leadership change, with Kevin Warsh expected to be confirmed as the new Fed chair next week. Industry experts note that without a clear signal of monetary easing, mortgage rates will likely hover in the mid-6% range through the spring rather than retreat toward pre-2022 levels. Refinancing activity remains muted at current rates since few homeowners can benefit by refinancing higher than their existing sub-4% loans, while 5/1 adjustable rate mortgages, ARMs, are averaging around 5.61% on initial rate, lower than the 30-year fixed. Housing affordability improves for first time since 2020. After years of worsening affordability, early 2026 is finally bringing modest relief for U.S. homebuyers. A median-income U.S. household can now comfortably afford a $331,483 home with 20% down, which is about $30,000 more house than a year ago. Typical mortgage payments are down roughly 8.4% year-over-year, as average 30-year mortgage rates fell to around 6.1% versus nearly 7% in early 2025, marking the first year-over-year decline in monthly payments since 2020. Buying power is now at its strongest level since March 2022, before interest rates spiked. The affordability gains are most pronounced in the nation's priciest markets. San Jose saw the largest boost with a median income family able to afford a $741,686 home, up from about $667,829 a year ago, a leap of nearly $74,000 in buying power. San Francisco buyers gained roughly $56,000 in budget, and Washington, D.C. households about $49,000. More moderately priced markets are also benefiting, with a median income household now able to afford roughly 446,982 homes for sale, about 82,300 more listings than 1 year ago, representing 40.3% of all listings, up from 34.8%. Markets with declines in home values have seen the biggest jumps in affordable listings. Houston leads with nearly 4,000 additional homes a median buyer can afford compared to last year, followed by Phoenix, plus 3,434, Dallas, plus 3,267, Miami, plus 2,981, and Atlanta, plus 2,279. Commercial lending surges amid refinancing wave. Commercial real estate financing is showing signs of life after a deep slump, with commercial and multifamily mortgage originations climbing 52% in Q1 2026 compared to the same period a year earlier. The gains were widespread. Healthcare properties led with a 209% year-over-year jump in dollar volume, followed by retail, up 148%, hotel, up 85%, industrial, up 56%, and multifamily, up 49%. The troubled office sector barely budged, with office loans essentially flat or down slightly, continuing to struggle amid high vacancy rates. Healthcare properties led the recovery with a dramatic 209% surge, while retail properties saw 148% growth. Industrial and multifamily sectors posted solid gains of 56% and 49% respectively, though the office sector remained stagnant with loans essentially flat or down slightly, reflecting ongoing challenges with high vacancy rates. A central factor driving the surge is a wave of maturing commercial mortgages that needed refinancing in early 2026, with depository banks increasing their CRE lending by 80% year-over-year, fueled in part by the large volume of bank-held loans coming due. Investor-driven lenders like debt funds saw the steepest jump with a 133% year-over-year surge in volume, while Fannie Mae and Freddie Mac boosted multifamily financing by 38%. MBA's Reggie Booker noted that the 52% increase reflects a meaningful rebound in lending activity, with the most notable increase being the 80% rise in depository lending, driven in part by the large volume of bank-held loans maturing this year. Investor-driven lenders led the market with a 133% surge, followed by depository banks at 80% growth and Fannie Mae/Freddie Mac at 38%. CMBS activity declined 14% year-over-year, reflecting continued headwinds in the commercial mortgage-backed securities market. Office market shows signs of stabilization. The U.S. office sector continues to face significant challenges but is showing early signs of stabilization after years of decline. National office vacancy rates stand at approximately 20%, with some central business districts experiencing even higher rates due to persistent hybrid work patterns. However, the rate of deterioration has slowed considerably, with vacancy essentially flat in Q1 2026 compared to continued increases seen throughout 2023 to 2024. The lack of new supply combined with an improving job market could over time help fill some empty offices, though experts caution that flat vacancy doesn't equal recovery and vacancy might linger high for years. The office sector may be finding a floor, with 2026 as a pivot from free fall to slow healing. Key metrics. Metric. Current status. National office vacancy rate. approximately 20%. Q1 2026 vacancy trend. Essentially flat. Projected value decline, 2019 to 2026. 30 to 40% cumulatively. Market outlook. Hybrid and remote work have fundamentally reshaped office demand in what appears to be a permanent shift, with even companies mandating return to office often settling for 3 to 4 days a week in person, which effectively requires less space per employee over time. Some pessimistic forecasts predict U.S. office values could drop 30 to 40% cumulatively from 2019 levels by 2026 if the trend persists, while others see a gradual rebalancing as markets adapt. Federal housing policy targets affordability crisis. The White House is taking aim at America's housing affordability crisis with new policy initiatives spotlighted in its 2026 economic agenda. The 2026 economic report of the president underscores how homeownership has become increasingly out of reach. By late 2024, a typical homebuyer's monthly mortgage payment had climbed to $2,400, up from about $1,400 in 2019. Over a longer horizon, real home prices surged roughly 82% from 2000 to 2023, far ahead of just 12% growth in real median income. The report notes how entry-level housing has dried up. Homes under $300,000 comprised nearly half of new construction in 2019 but only about 1/6 by 2024. The administration's plan focuses on three main levers: lowering borrowing costs through having Fannie Mae and Freddie Mac purchase $200 billion in mortgage-backed securities, boosting housing supply by pressing localities to ease zoning and permitting constraints, and curbing investor competition by limiting institutional investors from competing in the starter home market. The report estimates that regulations account for roughly 30% of a new home's cost in some cases, adding over $100,000 per unit. These proposals reflect a significant federal focus on housing, though they face challenges in implementation as deregulating local zoning is politically complex and limiting investor purchases might invite industry pushback. Policy lever. Target impact. Key metric. Financing, lower borrowing costs. Fannie Mae and Freddie Mac to purchase $200 billion in mortgage-backed securities to reduce rates. Monthly payment, $2,400, 2024, vs $1,400, 2019. Supply, reduce regulatory barriers. Press localities to ease zoning and permitting constraints. Regulations add 30% to new home cost, $100K plus per unit. Competition, limit investor purchases. Restrict institutional investors from competing in starter home market. Homes under $300,000, 50%, 2019, rightward arrow 17%, 2024, of new construction. Problem scope, price growth vs income. Restore balance between home prices and household incomes. Real home prices plus 82%, 2000 to 2023, vs real income plus 12%. PropTech revolution transforms real estate operations. Property technology has become a driving force in real estate in 2026, transforming how properties are developed, managed, and experienced. Over 72% of large commercial property portfolios in North America now use some form of smart building technology for operations. Governments and businesses alike are fully embracing these innovations. China's new 2026 to 2030 economic plan places heavy emphasis on tech-driven, sustainable development with incentives for smart cities, digital twin simulations of real estate projects, and green building standards. Landlords and property managers are increasingly favoring end-to-end management platforms over patchwork solutions, with major firms using software like Yardi or AppFolio that can handle everything from marketing vacancies and screening tenants to collecting rent and tracking maintenance requests. AI is central to many of these capabilities. Artificial intelligence tools are embedded into daily real estate tasks, automatically extracting key terms from leases, generating maintenance alerts, and forecasting property expenses, thereby reducing errors and speeding up decision-making. PropTech's influence extends beyond individual properties to entire cities, with smart city infrastructure on the rise and municipal governments partnering with tech firms to deploy IoT sensors for traffic management, energy efficiency, and predictive maintenance of utilities. REITs deliver strong earnings and raise guidance. Real estate investment trusts have started 2026 on a high note, reporting better than expected earnings and a brightening outlook. Out of the 23 REITs in the State Street Real Estate Select Sector ETF, 16 exceeded revenue estimates and 14 beat earnings forecasts for Q1. Big players in specialized sectors led the charge. Iron Mountain, Data Storage, upped its full-year funds from operations, FFO, and revenue outlook after a strong quarter. American Tower, Cell Towers, also raised its FFO and property revenue projections following an earnings beat, and Equinix, Data Centers, offered higher full-year revenue and FFO ranges despite a slight Q1 miss. REIT performance metrics. Metric. Value. Context. Q1 revenue beats. 16 of 23 REITs. 70% exceeded estimates. Q1 earnings beats. 14 of 23 REITs. 61% beat forecasts. FFO growth 2025. 3%. Baseline growth rate. FFO growth 2026, projected. 6%. Nearly double 2025 rate. JP Morgan Research projects that REIT FFO growth will accelerate from roughly 3% in 2025 to nearly 6% in 2026, essentially doubling the growth rate thanks to better capital markets and the economy moving into a recovery phase. Sector-specific drivers look promising. Data center and communications infrastructure REITs are particularly hot, riding the wave of AI and cloud computing expansion. Industrial/logistics REITs continue to benefit from e-commerce and supply chain demands, and healthcare REITs are supported by long-term demographic trends with aging baby boomers ensuring sustained occupancy in senior housing and medical office properties. Office REITs remain the primary laggards, still contending with low occupancy due to hybrid work. Rental market shows sharp geographic divergence. The U.S. rental housing market is showing mixed conditions in 2026, with some cities experiencing falling rents and rising vacancies while others hit new record highs. The median U.S. one-bedroom rent is actually slightly down 0.6% year-over-year, and two-bedroom rents are down 0.3%, the 10th straight month of annual declines in asking rents. However, beneath the national averages there's a stark split between markets. San Francisco rents have skyrocketed back to record highs, with one-bedrooms averaging an eye-popping $3,850, up 19.9% year-over-year, and two-bedrooms $5,340, up 22.8% year-over-year, the highest ever recorded in that city. Meanwhile, in markets flush with new units after over 600,000 new multifamily units were completed nationally in recent years, cities like Austin, Denver, and Phoenix have seen among the steepest rent declines, with rents down roughly 4 to 7% year-over-year. Los Angeles dropped out of the top 10 most expensive rental markets for the first time, with its one-bedroom rent falling roughly 3.9% year-over-year to $2,210 due to a record apartment construction spree. Chicago is warming up with relatively modest new supply, seeing one-bedroom rents jump roughly 8% over the past year, pushing it back into the top 10 priciest markets. Miami saw one-bedroom rents down roughly 4.4% year-over-year and two bedrooms down roughly 7.7% after several years of double-digit increases.